Yeah, so it'll be interesting tomorrow. So Apple's already up $1.30 after hours here for those of you that were taking the spread. So again, if it gaps up tomorrow, don't hesitate. Okay, I know this morning there's this nice gap up, this great opportunity to take profits. Some of you did, some of you didn't. And just remember, especially when you're doing weekly options like that, you're buying. You've got to take advantage of those opportunities to book profits. When you're selling, you get a little bit more leeway. Okay, so into the close today, we got the 555 calls, and then we sold the 565, 560 put credit spread. So tomorrow, if we gap up, peel some off. If it continues to trend higher, that's fantastic. But if it plummets, as it can do on those crazy Fridays, do that. All right, so let's see. All right, so yeah, pretty crazy with Apple and everything. Now let me make sure you guys can actually see my screen, because I think right now you cannot. You cannot. Okay, so let me move this over. And then, are you good like this? Can you see okay with this view? Because I kind of like to see the slides on the left. See what's coming up next. Okay, so so in this room, no, you actually in GoToWebinar, you can't see other people's questions. However, I will repeat them. GoToWebinar is just set up a little differently than the room that we use for trading. And I'm just going to dive into this. So for a while here, I may go back. If I miss one of your questions, don't worry. I want to plow through this and finish it today. So I may kind of just, I may be going for a while and not answering questions, but I will kind of look from time to time and see if there's anything there. Okay. Okay, so let's do this. Now, for those of you that have been in the room, and I'm assuming, a lot of you are here in the room. I know not everybody is, but what I want to do is just kind of finish up this options 101. And one of the things that I like to talk about is, of course, just in terms of options, is a lot of people come into options, they like to buy options, and I see people buying way out of the money options, and sometimes these are a good idea, and I actually do buy out of the money options sometimes, like a delta of 70, a delta of 30. However, here's the thing. If you're right, okay, if you're right on a stock, and I'll come back here and look at the chart real quick, and let's just say, let's come back here and look at Apple here and just look at this uptrend from yesterday. If you're right, if you're dead right on a stock, so here Apple went from 555 to like 575 in 2 days. If you're dead right on the stock, you could have bought the 560 calls here and made a lot of money, okay? If you bought the Delta 70 calls, you would have made a lot of money, but not as much of an exponential move in your option price because your delta was already pretty low, right? The nice thing is if you would have bought, say, a Delta 30 option here, by the time you got up here, that option would have turned into a Delta like 70 or 80 option. Problem is if you buy, say, like right here, say you buy a Delta 30 option and it goes against you, you're screwed. Because you actually have to get not only all the way back there, okay, to break even, but now you're fighting theta decay. So you actually, in this case, if you would have bought it an out of the money option here and it went against you, it'd have to actually go up $2 or $3, okay, just to get back to break even. That's the problem with the Delta 30 options, okay? If you're dead right, yes, out of the money options are the best way to go. However, being dead right in the market is a tricky thing at best, okay? Okay, so yes, and this webinar is being recorded, so that's why I talk about that. So, And the thing about it is too, again, like this morning was a good example. Okay, so we bought some Delta 70 options yesterday in the trading room on Apple. We bought them for like $8. This morning, Apple gaps up. Those $8 options are now trading for $12. Okay, you sell them. It's okay. You don't. That's the tough thing, is it's tempting. It's like, oh, maybe Apple's going to go to 600, and you want to keep holding on to them. It's okay to buy something at 8 and sell it at 12. Okay, you can make a living doing that. Walmart makes a living doing that. They make a nice living doing that. So try not to get too hung up on having to have a home run every time. Okay, as you're trading, you're in the retail business. Okay, you are looking to buy inventory at a low price, mark it up, and sell it at a high price. It doesn't have to be every trade that you do doesn't have to be the trade that's going to cause you to retire your job or anything like that. It's okay to do steady increments. Okay. All right. So the two themes in this presentation. First, professional traders are typically selling options, not buying them. Of course, you guys have all heard of that. And then if they do buy options, most professional traders actually like to go deeper in the money than I do. Okay, I like Delta 70s. Most of the professionals I talk to say if they're going to buy an option, they're going to go Delta 90. Okay, Tom Sosnoff is a good example of that. He will not. He would not buy an out-of-the-money call option if his life depended on it. I mean, literally, he just physically gets sick at the thought of doing it because he knows how much the premium and the volatility and the theta decay works against a buyer in that case. If he's going to buy a directional option, he's going to go Delta 80, Delta 90. Okay, but most of the time he's going to be actually doing selling stuff. Okay. Okay, so the other thing is that there are a lot of complicated option strategies out there you don't need. Now, I sometimes will make fun of, six-wing leg butterflies and stuff like that. There actually is a place for some of the strategies like iron condors. I'm honestly not a big fan of butterflies, but they do have their place. And the thing about it is they look kind of complicated, but really it's just different ways of doing credit spreads for the most part on a lot of those. I don't think you have to know a lot of complicated stuff to make money trading options, but there is a place for those. You're actually going to start seeing us doing more stuff like that, especially on some of the income generation trades and things like that as well. But in general, if you know the right options to buy, okay, and you know how and when to do, like, say, some credit spreads, you are going to be way ahead of most of the people out there. Okay. Now, for directional bias, I found it is best to focus on stocks that are trading over $50 per share. Okay. The reason for this is just bang for the buck. I mean, if you're looking at Bank of America and it's a $10 stock and you're buying options on it, I mean, the stock has to move 10% for you to get any decent movement in the option price. Okay. If you're trading, say, a $100 stock and it doesn't have to move 10%. It can move 1%, and you can make it, decent money on that option. So that's part of it too, because percentage-wise, stocks typically percentage-wise tend to move in about the same range. Okay. And then the other thing, of course, you want to make sure that they do have options trading on them. Of course, we all know the liquid names: Apple, Baidu, Google, Goldman Sachs, IBM, et cetera, et cetera. However, you can trade stocks that aren't very active, but you can only swing trade them. You can't day trade them. Like CME stock, I like to swing trade that, but I would never day trade it. The options are like $1 wide, but if you're going to look at a $10 move on CME stock, that's fine. Okay, Potash, that was one of the funnest stocks to trade a couple of years ago. It had these amazing moves, but it kind of rotates in and out which one's the fun one to trade like that. Of course, Apple's been fantastic for most of this year. Now, it's totally fine to trade other stock options on the lower price stocks too. I mean, one of the most memorable trades that I did in 2000, gosh, when was it? Has it already been 2 years? One of my favorite trades was on Rackspace, and it was this right here. So that was in July of 2010. That's insane. But it was just, I loaded up on call options here, because you had the weekly squeeze, you had the low ADX, and everything looked good here. And just this was one of my, in terms of the amount of money made on a trade, one of my biggest trades of 2010. And it was something that, it was just everything had lined up there. Everything was really, really nice. And that was a $20 stock. Okay, so there's of course exceptions to every rule, but as a rule of thumb, as a general rule of thumb, it's better to focus on those higher priced stocks. Okay, now one of the things that I tend to do is focus mostly on the underlying stock. Okay, I like to see what the underlying stock is doing and then set up a trade accordingly. However, I will do some things just based on high implied volatility, and those are some things that we'll talk about here in a little bit. But for the most part, I do a lot of my homework on the underlying stock. Okay, one of the biggest things I like to look at is in terms of active stocks and things like that is just a tighter bid-ask spread. So if you're going to day trade options, you need a tighter bid-ask spread. Google is okay most of the time. Okay, you can see here the spread 1060 by 1080. 20 cents isn't bad. 1570 by 16. 30 cents isn't bad. Once you start seeing 50-cent wide spreads, it's a little like, it's a little tricky to day trade. I'll still do it, especially like on the price lines of the world. I always say that if you're going to trade like the price line directionally, the price of admission is you got to fight with like a $1.50 spread, but then price line will move 10 or 20 bucks at a clip. All right, so that's what I want to see through those narrow spreads. Here's the spiders. Of course, the spiders have the narrowest spread. You can get penny-wide spreads here, 274 by 275. Spiders are fantastic for swing trading. Okay, you can get these fairly low-priced, very narrow spread. You can also day trade these. A lot of times you might see me in the room doing S&P trades on the S&P futures. Guess what? You could do those same trades if you using call options on the spiders. Again, on something like this, I would encourage you to use even a higher delta. You can go delta 80, delta 90, and if you bought 5 call options, that would be the same exposure as one S&P futures contract. Okay, so if you're trying to follow along and I'm doing one S&P futures contract, you do 5 call options. If I'm doing, or normally you do 10, say you do 10 S&P futures contracts, then you just do 50 spider call options. Okay, it's the same movement there. Now you'll want to get, that's why you want to get a high delta in those call options, because they'll kind of track it tick for tick. And then the other thing too, of course, on the delta, a lot of times what I'll do is when I bring it up, I just kind of look at the deltas first, and it'll say, oh, delta 40, 48, 55, 61, 67, 73. In this case, I'd want to buy the 102s. Same thing over here on the put side, delta, 40, 50, 69, 81, that's close enough, that's the 109s. So if I was doing directional trades on the spiders and I wanted to go long, of all these strikes, 102 through 109, I would be focusing on the $102 strike. And if I wanted to go, focus on the short side, I'd focus on the $109 strike. Okay, so buying options is relatively easy. The main thing is just to have a setup on the underlying stock. Now the squeeze on the daily chart works really, really well. You guys know I like that quite a bit. But you got to think of it this way: you're just using the option as a cheaper way to buy the stock. All right, $16 for an option is a lot cheaper than $160 for the stock. One option obviously is 100 shares of stock. A $16 option equals a $1,600 out-of-pocket cost. So here's an example with MasterCard. All right, so here we had a squeeze. It fired off short, and in this case, I remember this trade because I did buy puts on the retracement here. I bought deep in the money puts, and it almost immediately started going against me. Here's what I found with option trades. The best trades work out right away. If you're in an options trade and you're underwater the first couple of days, I mean, typically it's time to just try to scratch it out. So when it did roll over here, I wasn't even looking for it to take out the lows. I just got out for a scratch. Okay, that's just something that's just a rule I've learned. The best trades and options tend to work out right away. I'm willing to give them a couple of days, but if they work out from day one, the timing is right there. However, then we got the long squeeze here. Great. So what I did is just bought deep in the money call, okay, with the delta of 70. Now, one of the things a lot of people kind of don't like about this is that these these deep in the money calls are just more expensive. More expensive meaning the physical out-of-pocket cash that you have to spend. Okay. Now, on this particular one, the July options, okay, at this point on this trade only had 1 week of life left. So there's two options on here on a daily squeeze. You can buy deep in the money July options like the 155s, okay. And if you go here and you look at the price, you can see that the price here when this fired off was close to 165, 170. So you can look at the 155 Julys, and if the trade is still valid at expiration, then you can dump those and roll them into the August 155. You know, a lot of times people hear rolling like it's some magic thing. All rolling means is that you sell the one that you have and you just buy the next month out. Or what I like to do, honestly, is that on a daily squeeze, if there's only a week left of life in the option, I actually would just rather buy the next month out, and now you've got the gift of time. Okay, if you do a daily squeeze and the first couple of days it goes against you, man, you start getting pounded on that theta decay. Because remember, when the option starts going against you, not only are you losing intrinsic value, but the premium, you're getting theta decay. And that's why, you know, one of the things that's very frustrating is that, you know, say Apple's at 600, okay, let me get, I can get my drawing tool here. One of the things that can be very, very frustrating for options traders that aren't familiar with how options work is in a situation like this. Oh, Camtasia just crashed on me. That's awesome. Let me try this one more time here. Okay, we'll do this. Okay, here we go. So one of the most frustrating things is people is like, so say a stock is right here, and let's just say it's at $100. Okay, so it's at $100, and you buy the $95 call option, right? Okay, and then the stock comes down, and it comes back up to your entry. Well, guess what? The option price won't be the same here. So here, you may have paid $5 for the option. Okay, I know it looks like I'm writing like a kindergartner, but I'm using my mouse. If I use the $400 Wacom board, I guess that I could write a little bit better, but that's okay. But now when it comes all the way back, it'll probably be something like $470. Okay, it's going to have lost value. So that's one of the frustrating things about option is that if you're wrong from day one, then it actually has to come back more higher to get back to where you were. Okay, and that's just one of the things to be aware of. Okay. So in this case, then this is worse the closer to expiration. So let's say, you know, if it's a Thursday before expiration and this happens and you get back up to here, the option may be only worth $3. Okay, but if you do something like, and if you've got like a further time out, in this case, you know, 35, 40 days, then when it retraces, it'll be about the same price. So that's one of the things is that it's nice, and it's worth it to pay up for those out-of-the-money options. It's tougher for the bigger stocks like the Pricelines and the Apples because the prices are so out of whack. But a lot of times, like with a Goldman Sachs or a Baidu, you pay an extra $1 or $2, and you've got an extra 30 days. Okay, so in this case, okay, so the exit strategy is the same as the stock. I'm looking to scale out. Now the stop on the option is 50% of the value. Okay, so this is for swing trades. So if you buy a $16 option, then you're going to use $8 as a stop. That's as a general rule of thumb. Now you can tweak that. You can look at stops on the underlying, but generally you don't want to lose more than 50% of the value in a directional option. Okay. First target is 50%, and you can take off a third on that. Okay, so in this case that was $24. Second target is 100% of the move of the option, so for a third, so that's $32. Again, it was a $16 option, so a 100% move would take it to $32. And then the last piece I just hold for a squeeze loss of momentum or a TTM trend change. Okay, so if you look on here, the squeeze fires off long, you buy, you flip out a third, you flip out a third, and then once the squeeze starts to lose momentum, okay, and you can see it starts to lose momentum right here, right? Then at this point, even though the stock is trending higher and you know there's red TTMs, at this point you can just unload it. Okay, and so the stock, I mean, this is a good move. It went from 170 to 205. The $155 calls go from 17 to 155. That is a very healthy move. Okay, and again, yes, if we had bought, say, out of the money options, way out of the money options for like $3 here and sold them, for like 10, that would have been great, okay? But again, you're talking about you don't know if a squeeze is going to be a fantastic move that the squeezes can produce and often produce, or maybe more of a move like this where you get a decent move but not anything that you write home about. So that's the thing to think about there. So here in this case, if you had one contract, one option for 17 bucks, that would cost you $1,700 out of pocket. And if you sold it at 55, you'd sell it for 5,500, so you make $3,800 per contract. I'm real big on gains. I mean, you guys have seen me trade in the room. It's like, oh, just made 10 grand or something like that. I'm really big on what was the per contract. So don't get too caught up in the total P&L. It's great. If you made $300 per contract, how much did you risk to make $300 per contract? And that's really what you want to look at. Okay, so this slide here, and I've already talked about this, so some of these I kind of just talk about as I go, so I'm not going to repeat them. This is the question here, why not buy an out of the money option? Well, we've already talked about that, okay? Now, selling options is a more advanced strategy because there's more risk. Now, here's what's going to be interesting. In probably sometime in July, or June or July, I'm going to go up to the Tasty Trade offices in Chicago and spend a day, or not a day, but an hour in the morning kind of trading with Tom and Tony. Now, we all had totally different trading strategies because I'm more of a retail trained trader and they're off the floor. So they look at things that I don't, and I look at things that they don't. And we thought it'd be fun to kind of put our heads together and kind of trade together and compare strategies and stuff like that. So it'd be kind of fun. Now, for TradeStation kind of is what they do is that if you want to sell naked puts, you need to get level 4 option approval. Okay. If you want to sell naked calls on TradeStation, you want to get level 5 options approval. On Thinkorswim, they actually kind of treat you like adults. You can do whatever you want from the get-go. Now, on TradeStation at level 4, you can do everything except sell naked calls. Okay, selling naked calls is the riskiest thing you can do because it's attractive because the premiums are high. But what happens, and I think this happened to Linda Raschke, I remember talking to her once about it, and she said that she had sold some naked calls, like 50 of them, for like $3 or $4, and it was Thursday before expiration, and now they were only down to like 50 cents. She was going to collect the entire premium, and that morning the company announced that they got taken over, and the stock jumped like $60 a share. So she went from being up $3 to being down 60. I mean, it wiped her out. And that's why they're dangerous. Okay. Now you can do the vertical spreads, of course, and that's the case where it's like, wow, that call's expensive. I'm going to sell it. But I'm going to go ahead and buy one, 1 or 2 strikes above that as protection. Okay. All right. So let's take a look at those. Now, a couple of strategies: a bear call credit spread. The outlook on the stock is bearish or neutral. Bull put credit spread, outlook on the stock is bullish or neutral. The nice thing about doing spreads is you don't have to be dead right on the stock, okay? You can actually, if you do a directional call, okay, if you buy an in-the-money call and the stock starts trading sideways, you'll lose money. If you sell a put credit spread and the stock doesn't move, it just trades sideways, you'll make money. So there is an advantage to doing credit spreads in that way because you are trading on the side of the professionals. You are selling premium. Okay, so good question. So Kulu, John, for the smaller trader, those $17 deep in the money options are expensive. What do you do? Does it mean just buying one contract and not having the ability to scale out? Yes. So what you can do on that is, in that case, when you get to say the first target, like, okay, we're here, we've it's up 50%, so I want to go ahead and sell this position. Well, you're not going to sell it because you only have one contract, but what you do is you trail up your stop. Okay, at that point, you move your stop to break even. If it continues to go higher and now it's up 100%, great. Guess what? You move your stop loss to that first target, and so on and so on. And so that's the way to manage it, where you don't necessarily have to have multiple contracts to do it. Okay. Okay. What is the squeeze? I'll talk about that. Actually, this recording will be put together with some of the indicators that we use and everything too. Okay, so let's look at option credit spreads. Now, on that and I just stood up here. If you guys can't hear me, let me know, because I'm just standing up to stretch a little bit. On the MasterCard long daily squeeze example, we bought those deep in the money calls. Now, you could also do a bull put credit spread. In this case, you're focusing on selling premium, okay? Okay, just a little volume. It's a little warm. Take off this dress shirt. Okay, so we bought deep in the money 155 calls. Now we could have sold the at the money $170 puts outright. Okay, naked put, hoping it expires worthless, or we could have done a spread and sold the $170 at the money put and then bought the 160 puts as protection. Okay, now in this example that we made more money doing it directionally. However, had MasterCard just traded sideways, okay, we would have lost money on the directional, but on the put credit spread, we would have made money. Okay, so here's another little tidbit here. Yeah, I'm just looking at the PowerPoint right now. So here's the other thing. Now, let's say you're going to do 10 options at $17, okay? So that's going to be a $17,000 outlay. Well, this just looks like I'm writing like a kindergartner, doesn't it? Okay, so now if you're going to do a spread, say you do the, let's say the 170, let's say 160 puts credit spread, and you're going to sell it for $5, okay? Well, your max lot, so if you're selling it for $5, then, you know, if this is your total outlay, okay, you can put $17,000 on this trade. Say it's one contract, okay? Well, if you look at this, this is only $5. Well, you can do 5. You know, how many times does $500 go into 17,000? So you just kind of do the back of the envelope math, and it's like, okay, if it was 20 contracts, if it was 10,000, 40 contracts, if it was 20, so, you know, call it like 36 contracts. So on the spread, you could actually do 36 contracts, okay? And now you're talking, it's more apples to apples, whereas, you know, if you make 5 points on this trade, you'll make X, and if you make 5 points on this trade, you'll make the same amount, okay? The difference is that if the stock just takes off and runs, you're going to be better off on this trade. But you can have bigger size on the spreads, okay, to make up for it, to make up for the lack of that, okay? Yeah, it's a little tougher. That's a good point. So now, if you are, say, trading like a $5,000 account, it is tougher to do the $17 call options. And so if you are trading like, say, a $5,000 account, you are going to want to stick to lower priced options and actually sticking to spreads. Spreads are a good way to build up income that way because you have a lot less risk in the spread. You might be risking $2 to make $2 kind of a thing, and that's your workaround around that. All right, so yeah, and if you've got a small account, there are going to be some options that are out of your reach, and that's okay because there's plenty of I mean, one of my favorite stocks to trade is Goldman Sachs. You can buy options on Goldman Sachs for $3 all day long, okay? And so you just kind of sometimes will limit the stocks that you can do, and that's fine. You can build up to it. And I find, so typically on TradeStation, I find myself doing directional options. If I'm doing spreads, I typically will do them on Thinkorswim, although, you know, I'm doing more and more on Thinkorswim as well. But on, so options on TradeStation, this was kind of the old way to do it. You'd have to click options, click on spreads, and then on spreads there'd be a drop down, you go sell to open vertical. Well, now they've got the new Options Pro platform that makes it a lot easier, and of course most of you are already familiar with Thinkorswim, and you know, they make that a lot easier to do that. All right. So there's that one, we just covered that. So good question. So what kind of factor do you have when you're doing stops on credit spreads? You do 50%. So on a credit spread, if you do a credit spread and the strikes are $5 wide, and you sell it for $2.50. Well, now your max loss on the trade is $2.50, and your max profit is $2.50. But I still think it's good to split the difference. So the two ways to do it is, one, if you're not, say you don't want to risk more than $250 on a trade, great. You sell one contract on the credit spread because your max loss would be $250. So in that case, you could just say, all right, I'm just going to, this thing's either going to expire worthless, and that'll be within my acceptable loss limit because of my position sizing, right? Or if you want to do larger size in that case, you could just say, all right, I sold it for $250. If it goes to $350, I'm out of here. If it goes to $150, I'm going to cover. Steve, yes, this is being recorded, so you'll be good to go. And, oh, thanks, Daryl. Daryl's in there answering the questions. Okay, so let me focus back on the PowerPoint slides here. So here's a strategy I like to use. This is one of my favorite strategies, using implied volatility. And this is, I use this stocks that gap down on bad earnings or news. At the open, the options get expensive because there's a jump in implied volatility. And at this point, you sell to open a vertical put spread, selling the 360 put and buying the 350 put. You can also do these naked options as well. Of course, there's more risk there. But typically, a lot of times, the stock will gap down on nasty news and then start to retrace. Okay, and you can see the option price here. Here, Baidu gaps down. The option price, at the money option price, explodes because of implied volatility. This implied volatility stays this high for about 2 or 3 minutes. You want to be aggressive. You want to go in there and start hitting those orders. And then, essentially, from that point throughout the day, the stock, even if the stock traded dead sideways, this option would lose value, lose value, lose value, as the implied volatilities did that. Okay, so good question, Becky. On the bad news, you got to be in right away. Okay, if you wait, in this case, if you waited like 30 minutes, you missed it. So it is one of those things where the best entries you're going to get are the ones that you get in right away. And you got to remember, when there's bad news, a lot of that is priced in pre-market. Okay, so by the time it opens, it's actually fairly close to where it's going to be trading the rest of the day, which is kind of nice. So it's one of those things I like to do in the morning, is just kind of scan for that bad news. All right, now let's look at, okay, so we've talked about that, and we focused on that. Okay, so now I want to talk about, a little bit about, let me see here. Pinning, and I've talked about pinning before. And let's, just kind of get an idea. I actually like doing pinning more on monthly options. However, it has been working more and more on the weekly options as well. And typically what happens is that stocks tend to pin where there's the largest open interest. Okay, well, why is that? Because institutions sell a lot of these contracts and they don't want them to make money. So, for example, right here, there's a lot of open interest at 4,000 contracts. Typically, that'll be enough to drive the markets back to 1,000 or back to 100 so that these can expire worthless. Okay, now you see these and say they might be, if they depend on the different strategies that they did with it. You got to remember, a lot of the institutions aren't doing outright stuff. So you might go, well, if they sold 4,000 of these naked calls, gosh, they're fine, right? Well, no, a lot of them are spreads. So a lot of them do spreads and things like that. So it's actually more advantageous, or butterflies, for them to close right at the strike price. So you can see there that $4,000 strike. So it's very likely that Goldman's could catch a bid tomorrow and get close to $100. Okay. On Google's another fun one. And if you look at the open interest here, surprisingly, the open interest is kind of low at 600. Google just is notorious for going to $600. There are not any huge strikes out here that are standing out. So that's kind of the idea. And to give you an idea of how this works, I'll take you through a little bit of a scenario. This was some screenshots that I took while I was doing some penny plays. This was a monthly. These were all monthly options. This was monthly expiration. This was Friday, December 18th. 2009 at 9:40 a.m. The biggest difference right now is that when I'm doing pinning plays, I typically do them on Thinkorswim. It's a little easier. But what I do is I initiate these plays on Thursday night, okay, based on high open interest, and then we do debit spreads. There's not a debit credit spread, debit spreads on these, okay? So on this trade, what I was looking for was for for Google to get pinned at $600, okay? So you can see $600 right there. I was looking for Baidu to get pinned at $420 based on the open interest. I was looking for Apple to get pinned at $195. I was looking for MasterCard to get pinned at $250. And then I sold naked calls on GOLD, Randgold Resources, and I sold the 80, so I was looking for it to close below 80. And then this is just the S&Ps, okay? So immediately at the open here, because I pushed all these on Thursday night. Now it's Friday, 9:40 a.m. Central. The market's been open a little bit over an hour. S&Ps are choppy. We're down 50 cents. However, you can see Google gapped up, okay? So Google gapped up. So what I did on this is I bought the 595 calls, okay, and sold the $600 calls. Now you can see the ones that I bought are up $9,850, and the ones that I sold are up $900. Okay, even though we're going higher, it's just that that premium erosion. Now on Baidu, what I did was a ratio spread, a 3-to-1 ratio spread. So for every $410 call that I bought, okay, so every $410 call that I bought, I sold 3 of the 420s. And the reason I did that was because Baidu closed right up here, and the premium on these guys was out of whack. So I did a 3-to-1 risk-reward ratio. And so on Apple, this was a pretty straightforward one. Bought the 190s, sold the 195s, and then MasterCard bought the 240s, sold the 250s, et cetera, et cetera. Okay. All right. So that's the snapshot there. So now we go to the next slide, and it's an hour later. Okay. So Google here is acting good. This is what it's supposed to do. It's come up a little bit. It's coming off. It's acting fine. You can see I'm up $4,800 on the ones that I bought. I'm up $1,400 on the ones that I sold. And again, I would love to see this go to 600, and that would be, I would achieve max profit on the trade. Now Baidu, I am in trouble on this one. Remember, I want Baidu to pin at 420. Okay, it's collapsing here. So on Baidu, I'm actually down $19,600 on the options that I bought. However, what's saving me here is that I sold 3-to-1 ratio here, and actually I'm up 13,000 on the ones that I sold. So net, I'm down about $6,000 on that. Okay, so it's not horrible. It's not ideal, but it's not horrible. So okay, this one's giving me some trouble. Apple acts perfect. It popped up. It's pulled back a little bit. You can see here on Apple, on the ones that I bought, I'm up 2,000. The ones that I sold, I'm up 1,000. Okay, and then these call options, naked call options that I sold here, it's doing fantastic because it's below 80. Okay, so that looks really, really good. S&Ps are down about $2.50. Now MasterCard is giving me a little trouble as well, but this is a different kind of trouble. If MasterCard, you can see here on MasterCard, I'm down $5,250 on the calls that I sold, but I'm up $13,800 on the ones that I bought. So the nice thing about this is the debit spread. If MasterCard just takes off here, I'll still make the spread. I'm still going to make $10,000 on the trade. Okay, but sometimes it's disheartening to see, like, wow, gosh, if I didn't have these naked calls on here, I'd be making bank. And so that's, sometimes you can leg in and out of these as well. All right, so we're going to go to 1210. Here we are. Okay, so Google here is acting fantastic. This is exactly what you want to see, all right? And you can see here on my calls that I bought, we're kicking and screaming here. We're up almost $12,000. Now the ones that I sold, even though it's coming up here, I'm still up $1,150 because of all that premium erosion that dropped place overnight. Remember, as long as it closes under 600, those will expire worthless. Baidu's giving me like a heartburn here. So I'm still essentially down 19,000 on the ones that I bought. I'm making a little bit more money now on this premium erosion, but this is trouble, okay? I mean, if this thing just plummets, I could get in trouble here, so I got to be careful. Apple's looking good. Apple hadn't changed too much from the last update, just kind of sitting there. Again, I'm looking for that pin at 195. That's where the high open interest is. And look at MasterCard. MasterCard is just taking off. So MasterCard, I'm getting annihilated on the ones that I sold, but I've locked in a $10,000 spread. So no matter how high it goes, I'll lock that in. But I'm looking at this going, gosh, if I would have just sold this spread, right? If I had just sold the naked part of this and closed it out, I could just keep all of this money. But that's just a tough thing. You never know what's going to exactly happen here. Okay. Now Randgold Resources here is also giving me a little bit of trouble here. Okay. So now I'm only up $1,000, and the S&Ps here are bouncing a little bit. All right. So now let's go here and now look at 1:40 p.m. Central. Okay. This is what you got to do on expiration day. This is a full-time gig. So Google's looking good. Okay. Google there has not changed very much since the last update. Baidu here holding the lows. I'm just looking at this going, come on, man, hold the lows. Right now I'm about almost break even on the trade. I'm down 16,000 on the calls that I bought, and then up 14,000 on the calls that I sold. Okay. Apple, beautiful, beautiful, beautiful price action here on Apple. This is probably when Mark was getting short Apple. I can't remember. I can't even believe this was back at 195 bucks. But that's exactly what you want to see. You're just grinding higher here, grinding higher toward that strike. Now you can see Apple here, I'm getting paid. Now I'm up $7,000 suddenly on those calls that I bought, and up $700 on the one that I sold. MasterCard continues to rock and roll here, and I just have the spread. I'm up 24 on the ones that I bought, down 15 on the ones that I sold. And then Randgold Resources is giving me a little bit of trouble here, so I place a stop loss at the highs. Okay? Now, and then now we're at 2:15. We've got 45 minutes left in the day. Okay, Google acts great. It'd be really nice if we got up to 600. Again, this has been kind of the same all day, up 11,000 here, up 1,600 here. Baidu, man, this is just giving me heartburn here. I really don't want this to collapse. That's going to hurt. Right now I'm hoping for more of a, a small win. So right now you can see I'm up on the day. Okay, I'm up 14,900 on the ones that I sold, and down 12,600 on the ones that I bought. So right now I'm up about 2K. Okay, so this trade, even though it's not going in my favor because it was a ratio spread, is working in my favor. Okay, Apple acts fantastic. MasterCard is just unstoppable, but of course I'm making the spread. I'm up 30 on the ones that I bought, down 21 on the ones that I sold. Again, if I was a genius, I just would have taken off my naked position here and just made all that money. And here we are at 2:45, 15 minutes left in the markets. Okay, Google still acts pretty good. I'd still like it to see it pop up here. Baidu, now it's a problem child. It's rolling back over. Okay, you can see here now I got an issue. I'm down 6,000 again. Apple, perfectly pinned. Okay, perfectly pinned there. MasterCard just on fire here, and Randgold Resources still giving me a little bit of a problem. Okay, but overall it was a very profitable day. I mean, essentially on Apple made $11,000. On Google ended up with about $9,000. On Baidu I did lose. This was close to the closing trade. I did lose about $6,000. Randgold Resources ended up making about $3,000, and then on MasterCard made 10. So overall, it was a very, very good, in terms of trading, it was a good options expiration day. There's a couple of curveballs there, but that's about it, okay? So let me do this, guys. I think that's a good place to take a break. Let me just, let's pause here. You guys think about what I just told you. I just threw a lot at you. Let me take about a 10-minute break here, and then I will come back. We'll answer questions about the pinning, and then we will dive into the questions, okay? Because that's a lot of information there and you want to process it, okay? So break for 10 to 15 minutes. All right, guys? Be right back. Okay, guys, let me just, I'm back here. Just want to double check. You guys can hear okay? Okay, awesome. So I kind of flew through that last presentation. And I did it for a reason, is that the only really way to teach pinning is to do it live. So I wanted to give you guys a general idea of how it works, but what we'll do is, of course, I'm still not a huge fan of weekly pinning. I mean, it does work to some extent, but I have not seen it as consistent. But what we will do is the next monthly pin is do that live as well. So I wanted to throw that at you guys, and we'll do live pinning. I think we can probably open up the room for everyone and do a live pinning on Thursday, Friday for the monthly expiration. But before I say that, let me just double check my calendar. The good news is you guys have noticed that the first half of the year my travel schedule was hell. I actually only have one more trip scheduled the rest of the year, and after that, the only other trips would be like trade shows and stuff like that. My travel schedule is light, and by God, I'm going to keep it that way. So, yeah, so that'll be fine. So June 15th expiration. So that's what we'll be looking at doing that again. Dave, I mean, that's a good, okay, so Dave, he set up an Excel spreadsheet that examines all the open interest and volume for the 8 strikes of Apple and gives you an average put price per option. I think that's great, Dave. I mean, I kind of eyeball it, but honestly, I think that much detail would help. I mean, I think that would be pretty good. Yeah, and last month's pin was a little crazy, and then we had some really strange moves in some of the stocks. The thing about it is pins work good in what I call normal market conditions. This last monthly pin, I mean, the markets were kind of going crazy. You had all this stuff coming out of Europe and stuff like that. You know, pinning is very strong in what I call "quote unquote" normal, normal situations. But what you do, so just as a quick kind of a diagram here. So let's use that Apple trade as an example. Okay, so here's the pin. Oh, that just did not work. Let's try that again. So let's say here's where we want it to pin, right at 195. Okay, so here's 195. So you buy the 190 call, okay, and then you sell the 195 calls, okay? So this is a debit spread, not a credit spread. Okay, and these are calls. So you actually want the 190 to increase in price, okay, and then you want the 195 to decrease in price. So if Apple starts off like right here, right, and you buy the 190 call for $3, all right, and then you sell the 195 call, let's say for 80 cents, okay, and then in a perfect world, what happens is we rally to 195 and close there, and then this option that you bought is now worth $5, okay, and this one that you sold is now worth 0. Okay, so you actually net $580 on the trade. Oh, sorry, that's incorrect. You net $280 on the trade because you made $280, per. So you made $2 here, okay, and you made 80 cents here because that expired worthless. So that's what you're doing on the pin. Now the good thing is that if Apple just blows through this and keeps going higher, you're actually still going to make your max profit. Okay, you're still going to make $280. Even if it goes up $100, all right? The downside is, and then if it trades sideways, okay, and guess what too, if it trades sideways, you still make money because this goes worthless, right? The downside is if if Apple just gets crushed, then you're faced with max loss. And that's why you got to monitor it. You don't have to hold it into the close. You can actually sit there and take it off and leg back out of it. But that's the general idea. Okay? Is there advantage to selling deep in the money calls or put spreads versus at the money? No, not really, Rick, because if you sell something deep in the money, okay, it's a good question. So this is my official whiteboard now. So let's use Apple as an example. So let's say Apple today closed at 565, and let's say you think it's going to go to 575. Okay. So what if you sold so it's at 565, you think it's going to go to 575. Well, what if you think it's going to go to 575, why not just sell the 575 or 575, 565, and you'll probably get like $4 for it, right? Well, now what's got to happen is the stock has to rally $10 for you to make $4. Okay, and a lot of this is intrinsic value. The 565 you can probably sell for $250. Okay, it's all premium. Apple doesn't have to do anything, and you can make max profit. Apple can trade dead sideways, and you can make $250. Okay, so essentially here you're either saying, okay, it can rally $10 and I can make $4, or it can do nothing and I can make $250. In my world, in terms of stocks, I would love if the stock doesn't do anything and I make $250, I'll take that every day of the week. Okay, does that make sense? Well, so okay, so Attilia just had a good question here. Now my math might be wrong, but I think it's correct. If I am wrong, just tell me. All right, so we made on that one example, right? We made $2 on those options that we bought, and then the 80-cent ones expired worthless. Okay, well, remember, even if this option goes to $5, the premium is now gone. It's just all intrinsic value. Does that make sense? So you really lost $4.20 on this. Okay, and then over here, okay, let's say it went to 200, and then instead of making $2, you made $7 over here. So $7 minus 420 is 280. So you actually do make 280. Does that make sense? I see what you're saying, because it's like, oh no, you wouldn't make that 80 cents, but if it goes to $5, you're only down 420 because you already got an 80-cent credit. All right, so that's a good question though. All right, so let's kind of dive in here. And I'm gonna cover this more. I wanted to show it to you guys, and it's easier to do live. But what we'll do is when we come to June is we'll open up the room and we'll do that live. Okay. So so let me switch this out here. That's slide 63. So because I got a couple of other cool things to show you. Okay, so a couple of you guys were asking about what the squeeze is. So what the squeeze is, and the reason it's so important, is the squeeze is a volatility indicator. And a volatility indicator is the most important type of indicator. There's three types of indicators. There are trend following indicators, for example, moving averages. There are oscillating indicators, like the RSI, and then there are volatility indicators, kind of like Bollinger Bands with squeeze. Now, the volatility indicator tells you when a market is going to go from quiet, okay, and a quiet market is reversion to the mean market. Okay, when you see that a market is quiet, trading a range, this is a great time to sell premium. Okay, this is when you sell put credit spreads, you sell call credit spreads, you can do iron condors. But once you see the squeeze set up, you know that a big move is about to take place. This is when you don't want to do an iron condor, okay, when this is setting up, because you know a big move is about to take place. And this is when, especially if you've got like waves and directional things, you can actually start selling put credit spreads, okay, or buying directional calls at these levels. And and there's a lot of times, and I talk to people too who are a big fan of doing delta neutral plays. So what they'll do is they'll buy delta 70 options and then sell the 30s, so there'll be a delta neutral. I'm not a huge fan of that. I think with the squeeze, with the directional play, you want to give yourself room to have a big trade, and if you cap it off by selling premium, you're locking yourself in. Now, I'm a big fan of spreads, but I think there's times when you don't want to do a spread, you actually want to take advantage of the directional nature, and that's when you get a daily squeeze. Okay, so on something like this, we do want to go in and just kind of take a look at. Okay, let's take a look at, in this case, Google. Last price is $546. We just come down to the delta and say, oh, 77. So that's the $520 call on this at this point. Okay, so that's $34. So you just have to look at this and say, okay, if I'm trading a $5,000 or $10,000 account, then Google may not be the right option trade here. Okay, and I would just say go find another one. Go look at Goldman Sachs. Go look at Rackspace. It's a $50 stock, and you can do the same thing like that. Okay, that's the tricky thing about those higher priced options like that. Now, the thing you could do in a small account, though, having said that, okay, the larger account actually just gives you more flexibility to be able to do a directional play. But if you still really like that setup in Google, that's fine. You know what? You buy this for $33.50, the $520 call, okay? You can still buy that in the money call, but then you go up here and say, okay, we're at $546. I'm going to go ahead and say sell the $560 call for $11.60, okay? Or you could buy the 530s, okay, and sell the 560s. So now you're actually creating a debit spread and you're reducing your cost of the option, okay? So there are ways to do that if you've got a smaller account. Okay, so, but the easiest way to make money trading options is what it is in a regular bull market, because bull markets are slow. Okay, you guys know how fast markets fall, right? I mean, markets fall very, very fast, but they grind higher. The easiest way to make money trading options is in a bull market like this, because the volatility is low, so you're not having to pay up. And then when you get a squeeze, you just can sit there and ride the trend. In a downtrend like this, the volatility is very, very high, so you got to actually pay up for the options. Okay, but in an uptrend like this, the volatility is very, very low. So in an uptrend, it's actually easier making money. It's more favorable conditions to make money trading options. Okay, but of course, in a downtrend, you can make profits faster. You just got to pay up for those options. All right. So this is a weekly chart. I really like these. These weekly squeezes are so powerful. And we'll look at some live examples here shortly, too. I just want to make sure I covered all of these. All right, so let me go here. We've talked about the spreads. Okay, so I want to go in and talk about this. And I've showed this strategy a couple of times. I mean, I skipped those other slides because we've already talked about that. We've already talked about everything that was going on with Apple. Well, you know what? I say that, but let me go back here. I don't want to assume that you guys know all this stuff. So, all right. So if you have a daily squeeze, what are some other strategies that you could do? Okay, let's say you have a daily squeeze on Google and you don't want to pay up $34 to buy a deep in the money call. What are some other things that you can do? Well, you can do naked puts. Okay, naked puts. They're not, especially in an uptrending market. They're not that dangerous. They're certainly not as dangerous as naked calls. Of course, you can cover yourself by doing a spread, but doing far out of the money naked puts is a great way to do this because they actually have a high probability of expiring worthless. If you're worried about it, great. Just sell the next one out. You're covered. Okay. In the case of a long squeeze, if the move is really, really strong, you're going to make more money by buying an in-the-money call. But say you've got a retirement account or you're just looking for income, then it's actually a little bit safer to just sell premium. Okay, so you sell the put, let it expire worthless or let it fall, and do that. I know one guy that I know, he's got a large account. Every month he does the same strategy. Once a month, he sells Google put options that are $50 out of the money. They're like $4. He sells them, collects the premium, 10 times out of 12 they expire worthless. If there are some things that, the market's a little goofy, then he's got to, kind of leg in and out of it and add some, add some protection there. But, those larger price stocks, you can go far out of the money. You can sell those options and then, you're hoping that the market just continues going higher or trade sideways or doesn't fall $50. That's all Google has to do is not fall $50, okay? Puts a little hair on your chest when it falls $45. But that's what you're looking at. Obviously, you don't want to do this like right before earnings or anything like that. So it's a great income strategy, but of course, to sell a naked put like that, you have to have a larger account. You could still do a credit spread, of course. And that's the nice thing on something like this. If Google goes higher, you make money. If Google goes sideways, you make money. And if Google falls like $20, you still make max profit. So it's a beautiful strategy and something to think about there just for general income. Okay, so that's naked puts. Got it. What else? Of course, option credit spreads are also great. The limited loss feature is a plus. It also gives you some cushion in case the direction doesn't work out as planned. All right. Overall, I tend to like naked puts and credit spreads 1 to 2 weeks out from expiration. Sometimes I will go a little bit further out, but if you're doing it 6 or 8 weeks out, at that point I'd rather just do a directional play. All right. If you are 2 weeks or less from options expiration, credit spreads are very, very nice because you don't have to be dead right. You can still make money with the stock. You are betting to go higher, only trade sideways. That's a plus. And credit spreads are more of a, if you think of it this way, credit spreads are more of a bet where the stock won't go by options expiration. Since it's so hard to predict where a stock will go, it's actually kind of nice because you're only saying, oh, I bet the stock won't go here, and then you can make money that way. So, for example, here's this, and you can do this hourly too. So here's an hourly squeeze on Apple in this case. You know, you could sell the 225, 220 put credit spread, and the bet that you're making is that this stock just isn't going to come all the way back here. Okay, you're betting that it's going to go sideways or it's going to go higher, but you're just placing a bet that it's not going to come back to this point or lower. Okay, so it's kind of a nice way to do it, and it's a nice way to generate income. So for an hourly squeeze fires off on this particular one, and a lot of times people don't think about this. You can do put credit spreads on hourly squeezes. Okay, so in this case, the Apple hourly squeeze fires off at 224.50. God, these prices look so low on Apple, but everything I'm talking about here is very valid today. If that was 624.50, okay, it's the same thing. So we buy the $220 calls. Okay, we sell the same number of $230 calls. Now, as you get more advanced, you can actually do ratio spreads. So, for example, for every one $220 call you sold, you could sell two or 3 of the 230 calls. Okay, this is more of an advanced strategy though, because you have got to watch this one like a hawk. The nice thing about this is you collect premium at 2 to 3 times the normal rate. The disadvantage is if it goes against you quickly, you could get hammered very, very fast. Okay, it's a little bit more of an advanced strategy. I've not done it very much in the room, so I want to kind of get everybody kind of up to speed and used to what's going on there. But it is a very, very viable strategy. All right. In this case, Apple can trade sideways for an hour or move higher, and we will make money. So it's actually perfectly okay. A lot of times people think of credit spreads of like, okay, I'm going to buy this, I'm going to sell this credit spread on Monday, and we're going to get out on Friday. Now, you can sell a credit spread at 10 and get out at 11. Okay, just like you're thinking of making 50 cents or $1 on the credit spread. Okay, and that's perfectly fine. You can do that with options that expire 1 to 2 weeks out. If it's 6 months out, you can't do that. So in this case, if Apple moved from $224.50 to $228.50, $4, okay, Apple can sneeze and move $4, then you close the position. Okay, we would have made the money on the spread that way. Okay, so you don't have to let it expire worthless. You can just make 50 cents or $1 and move on. All right, that makes sense? Let me see if there's any questions on that. So on that one, you lose if the stock goes down. Okay, so in this one. So we looked at the hourly chart, right? So you had the hourly squeeze. Apple's trading at 200 and it was, I don't remember, it was 220, like $224, right? So you sell the 225, 220, and if it trades sideways, you make a little bit of money. But even better if it could rally a little bit. In this case, it rallied to 228. Then this credit spread will take a nosedive. You probably sell it for about 250. It will drop down to about 180 or even more. Great. That doesn't have to expire worthless. A lot of times people are like, oh, let's let it expire worthless. You made 70 cents. Okay, that's not bad for an hour's worth of work. That's $70 a contract, $70 an hour. You got 10 contracts, you're making $700 an hour. So that's one way to look at that. You don't have to let it expire worthless. It's just like this morning, okay? Apple gapped up $5, and a lot of us had call options there. You just got, we got into that trade 10 minutes before the close, and it opens up $5. You're in a trade for 15 minutes. You take those profits when you're handed to them. Don't just hold on and hold on and hold on and hope that something's going to come of it, okay? That's a really great strategy with Apple because it just gaps up so consistently in these uptrending markets. So we'll see what it does tomorrow. So how you lose on this, then, to answer your question is, so, okay, again, we could go sideways and make money. We could go up and make money. So if Apple just takes a nosedive here and drops to like 220, then your put credit spread is in danger. Now, you won't lose the whole thing. The same thing, you'd lose about 70 or 80 cents. All right? Okay, so let me get, okay, so that's that one. So I'm going to do this. Now, I've shared this a couple of times. However, I really like this example because it really does sum up my favorite trading strategy for directionally trading options. And so let's take a look at this. So here's an hourly chart. Now the waves, if I haven't talked about the waves here, the waves, the C, B, and the A waves, these are trend following indicators, okay? If the C wave above 0, it's telling us that the longer term trend on whatever time frame and whatever market you're watching is higher, okay? And this happens to be Goldman Sachs on an hourly chart. So the long-term trend is higher, the medium-term trend is higher, and the A wave is telling us that, yeah, there's a little bit of selling right here, but it's moved back up and now it's higher, okay? And we've got a squeeze. So when you have a squeeze that sets up like this, and you've got the C wave going higher and the B wave going higher and the A wave accelerating, the chances are incredibly strong that this will fire off long, okay? So on something like this, I like to sneak into this trade. This is a great example here. The stock is at $159.80. We're going to buy the November $155 calls, and if I remember correctly, these options were about $7.35, okay? And I've got a record of the trades coming up. So that's reasonable, okay? You're not having to buy a $34 option or anything like that. Now remember, all the stuff we just talked about, okay? I'm going to talk about this as a directional play, okay, of just buying the 155 calls. Now, you could have also sold the 160 put, right? If you say you have a smaller account, you're like, God, I don't want to pay up $7 for an option. That's $700 an option. I only got a $5,000 account. Great. Sell the $160 put, buy the 155s. You're getting a credit of like $2, okay, and you can do this trade, all right? So when I'm focusing this on a directional trade, you could also do a put credit spread, okay? You can also do a debit spread. I'm not a huge fan of debit spreads on this kind of a trade, but put credit spread would be just fine. Okay, so that's the first slide. Now, if you look at the daily chart on Amazon, and this is a key that a lot of times people miss, you've got the trades that are going to work out the best are the ones that are going to be in alignment with the bigger picture. So we just looked at that hourly chart is very bullish, right? You had the C wave above 0, you had the B wave above 0, and the A wave above 0. Well, look at this. This is the daily chart of Goldman Sachs, and what do we have? Okay, same thing. You've got the longer-term trend higher, the medium-term trend higher, and the shorter-term trend higher. In other words, that hourly chart is firing in the same direction as the daily chart. Those are the most powerful trends. It is so much better to wait for those to line up, okay, and take those as opposed to just, I'm going to take all these different trades. Just be patient and wait for those to line up. Now, as an added bonus, in this case, the weekly was also long. That's a bonus. It doesn't have to happen. It doesn't have to be like that. A weekly could actually be in a downtrend. That's fine. But if it happens to be in an uptrend, we're firing off a squeeze, that's great. I would just consider it a bonus. Okay, so in this case, I want to go in the money on the calls with an option delta of, guess what, very close to 70. In this case, the November 155 calls, okay, had a delta of 68, which is very close enough to 70, so that's fine. Now, the other question here is then, where do you place a stop? Where's your risk? Well, if you're not sure, then just bring up the hourly chart and put up a 14-period average true range, okay? That's going to tell you what the average true range of this stock is over the past 14 bars. In this case, it's $1.03. Okay, so what I like to do is double that, and that's my stop. So the thing about it is, if $1.03 is the average true range, then you want to have a stop loss that's outside the average true range. Okay, and if you double it, that's pretty much a good bet. So minimum stop on this is 206. Sometimes I'll go even with a bigger stop, but that's your minimum stop. It's 2 times the ATR. Okay. Now on the same day, just to kind of give you another example here, Amazon also set up a squeeze at the same time. Amazon is like one of my favorite stocks to trade. Now what's wrong with this picture? Here's a squeeze and it fires off short. Why would I not take this trade? What do you guys think? Okay, so Steve, right, Steve. So it fires off short, but you've got a C wave above 0, which is positive. The B wave is just crossing, but it's essentially positive. In other words, there's conflict here. This is trying to go lower, but the longer-term trend is still pointing higher. And what that means is typically you're going to get kind of a shaky move. Now, sometimes you'll get a fantastic move, but more often than not, you'll get kind of a shaky move. And that's not something that's really worth dealing with. So when I see something like this, I just avoid it. I'm just like, you know what? There's so many other opportunities out there. Let's wait and see what the next one is. Okay, so in this case, on Goldman Sachs, the stop is just below support at $156. The target is the 1272 extension at 163. You hear Carolyn talk about extensions a lot. I really like to use her extensions for targets in this kind of a situation. In this case, you're going to take at least half off at this first target, move your stop to your entry point, and then decide whether or not you want to manage a runner. Okay, now this is going to depend on your temperament, market conditions, etc. It's okay if you just want to make $2 and get the hell out of there. That's fine. Okay, I think a good rule of thumb, for example, when the Apple gapped up this morning, when you get a 5-point gap up like that, you should automatically be selling half your position. Okay, just sell half. I mean, you just made 5 points in 13 minutes of work. Now you had to hold it overnight, but the market was only open. If you bought it at the close and sell it at the open. So you never want to let those opportunities pass you by like that. And then from there you can manage the rest of it. But at least you will book some profits. Okay? Now what was interesting on this trade, so for those of you that don't know what the 1272 extension is, it's just a very simple calculation. You just use Fibonacci numbers. So this happens to be a daily chart. That was the prior high. Now it was coming back up and through that high again. That's what you're looking for. If it goes through that high again, then you've got a 90% chance of going up to the 1272 extension. And what was happening on this is in this period of time right here, an hourly squeeze fired off, okay, long in the direction of this uptrend. So I was looking for a move to slam into that 1272 extension. Okay, so it's nice having these big daily charts like this and then taking hourly squeezes in the context of this bigger action. Okay, so that's what I was looking for there, is that 1272 extension. Now what you do is you swing high, and when you look at when we're breaking through again, you just go back and say, okay, where was this lowest low? Was it here? No. Where was the lowest low prior to this? Oh, here it is, right here. So then at that point, you just draw, bam, okay, that move there, okay, and it's gonna come up here, and then it's the 1272 extension of that move. So there's a 90% chance it'll hit. The 1618 has got about a 60% chance of hitting, but on something like this that's this big, we're taking the trade off of an hourly chart. I'm just looking at that 1272 extension and then get out of there. All right. Again, in trading, bears make money, bulls get money, make money, and pigs get slaughtered. If you get overly greedy in the market, it's a death knell. I got to tell you, every successful trader I've talked to, one of the things that they always tell me, and it's something that I had to learn too, is that you sell too soon. Okay, if you want to make money in the markets, you sell too soon. That's a fine line. You don't want to sell when you made one tick. Okay, one tick that's not trading. But the question is for an example like this, when you have a clear target of the 1272 extension, you dump your position even a little early. Okay, instead of hoping that it's going to go up to here. Okay. That's what that means. Okay, so the 1618 extension gives you a goal range for a second target. That is hit about 35% of the time. Now, I will do that sometimes if the market is really, really strong, but most of the time I'm happy to take my profits and move on to the next one. So a lot of times what I can do is, when it's hit the first target, I'll take off half my position. Then I may hold on to the second half for a TTM trend change, okay? Which is a good one. And it's discretionary. Once you take some profits off the table and move your stop to break even, that's where your skills as a trader come into play. Okay, that is when you, kind of learn your chops as a trader in that case. So if we look here then at, so in this particular case, you can see Goldman's, you've got the squeeze, you've got a nice move, and then you can actually get out of the rest of the trade when you get 2 red TTMs, okay, like right there. Now, this was a very interesting trade because on this particular trade, and I documented this real time as I went. We had some mentors here. I was doing it real time. On this trade, I sold half of the trade when prices hit 163. Then I noticed the tick indicator dived and went to -1,000, and the S&Ps went from +8 to -2. Now, Goldman Sachs actually held up during this I was very, very surprised. Goldman Sachs actually held up very, very well during this move, but that's a little disconcerting when you see that huge selling. So I ended up dumping the rest of the contracts right at 163 because the ticks were so ugly. So you can sit there and use internals as well. And in fact, here I took a screenshot of this. I mean, you can see here, here's the S&Ps. This is that same day I was in the trade. Suddenly the ticks come down here and just get pounded into submission. The S&Ps crater, okay? But Goldman Sachs actually held up. It was up like 2.5 points and came down a little bit, and it held up very, very well. Okay, but you've got to be careful with stuff like that. That's why you want to learn the internals and learn the ticks. Even if you're trading stocks, the nice thing about Goldman Sachs on that particular day, ignore the ticks, but most stocks don't, right? If you're in Apple and the ticks suddenly plummet, guess what? Apple's going to most likely go down as well. All right, so on this particular trade, now this is a bigger trade. I mean, I did do 300 contracts on this. However, I don't want you to get too caught up in the total profit, okay? 300 contracts was good for $55,000. What I want you to focus on is I bought these at $7.25 and sold them for $9.05, okay? And I scaled in. So some were at $7.35, sold at $9.25, et cetera, et cetera. What I want you to focus on here is that you can actually make a decent living making 2 points, okay, or $1.70 on these trades. You don't have to this doesn't have to be a double, okay? This doesn't have to be a triple. You can buy options for $7, sell them for $9, and make a living, okay? And so I just want to kind of hammer that home here, especially on those hourly squeezes where you're just in it for a quick amount of time and you get out. And if you think about how to make money trading options, the shorter, if you're buying options, the shorter you're in the position, the less amount of time you're in the position, the better, because you've got theta decay working against you. When you're selling options, it's fine. It's not a big deal. But if you are buying options, you don't want to be in them for a very long time. So if you get $2 or $3 and you get a nice pop, just take some profits. Okay, so that's kind of the point I wanted to hammer home there. Now, what if disaster strikes? Like for example, today I had a run at 11 o'clock with a trainer. And I had a couple of the last pieces of Apple on, and I was trying to get out. And today Apple was just kind of sloppy, and it was kind of selling off. And I had some limit orders in; it wasn't getting filled, and I had to go meet the trainer. Well, I could have just left the limit order on and then went and ran. Okay, the stock Apple was up at $1 on the day at the time, or I could have just gotten out. Now I just got out because my personal experience is like, I don't want to miss a trade by 20 cents and have Apple fall. Now Apple ended up falling more, so it's good that I got out. But there's going to be times, too, when you come back, and if you would have left it in, it would have hit your order. So the one thing I want you guys to get your arms wrapped around is that to be a successful trader, you've got to learn to take small losses, okay? You've got to learn to not associate success, or personal self-esteem with your P&L. You've got to cut stuff off at the knees. Don't worry too much about the perfect trade or doing. There's no perfect trade. I mean, you can only trade the action that's in front of you. But if you've got a trade that's not working out, cut it off, because you can always get back in. Okay, so don't. More fortunes have been lost in the markets from people trying to prove themselves right. Okay, everybody, a lot of people that are successful in life, they've got good credentials, they've got an MBA or whatever, and they've made a living being successful at things. Now you come to the markets. If you apply that same thing, and if you're down 2 points on the day, and you try to sell it for a loss, that doesn't jive. It's like, wait, I make a living being successful. If I sell this for a 2-point loss, I'm not successful. Therefore, I'm just going to keep holding on to this losing trade until it goes profitable, and that way I can delay. I can delay myself feeling like crap because I made a loss. You've got to eradicate that thinking from your brain. Okay, successful traders. A lot of successful traders I know have a 50% loss ratio, but guess what? Their losses are small, their winners are big. Okay, so don't worry about taking small losses. Okay, so we looked at that. Another thing is that I don't really mess with trades. I do 5-minute charts. I don't really go below 5-minute charts when trading options. I'm not doing 377 tick charts or anything like that. I do that more with futures, because futures, you've got that tight bid-ask spread and you don't have any premium or anything like that. Okay? All right.